You might be doing all the right things with your money. Investing, negotiating your salary every year, not keeping up with the Joneses, and building an emergency fund. But even so, you're not seeing results. Why? You might have a few drawbacks that's keeping you back from reaching your full wealth building potential. You might even be getting financial advice from people where you're actually questioning whether they have your best interests at heart. Take Kobus, for example. He took my course where he learned about fees, how to check fees, how to ask what his fees are, but also realizing what the impact of fees on his investments are in the long term. He also realized what acceptable fees are and that there are investments out there that have way less fees. When he investigated a little bit deeper, he realized that he was paying 3% in fees annually. It doesn't sound like much, but if you've been around for a while, you would know that 3% is a devastating amount to give away of your wealth every year. After this discovery, and after the 5 weeks of learning, he knew exactly what to do to reduce his fees significantly. And by that I mean going from a 3% fee to a 0.5% fee. That's 1/6 of the cost. So this video is part 2 of my 3-part series on the financial freedom formula. In the last video, we talked about what to increase to build wealth. Today, we talk about what to decrease or what to eliminate in order to stop sabotaging your wealth building journey. I'll tell you about the 3 biggest wealth leaks most people don't notice and why these matter even more if you're investing. Also, how you can start fixing them immediately. If you've ever felt unsure about whether you're doing the right thing with your investments or whether you're paying too much in fees, you need to sign up for my free masterclass. It's coming up soon and it's 90 minutes long, packed with valuable information. Follow the link in the description if you want to join. Think about it this way. Pouring water into a bucket is great. You would expect it to be filling up. But if you have holes in that bucket, then it's going to take you much longer to fill up. So let's consider how we can plug some of these holes. So the obvious things that you need to reduce in order to build wealth is to reduce your lifestyle inflation. Constant upgrades to your home, car, holidays, wardrobes, etc. have bigger effects than the immediate obvious impact on your bank balance. The biggest loss is not the $100 that you spent on your new skirt. It's about what that $100 could have been worth 20 or 30 years from now. It's tempting to spend more as your income goes up, but keeping your lifestyle in check and letting the gap between your income and expenses grow is where real security comes from. That means as your income increases, you're not increasing your costs at the same rate. And therefore you can create a bigger and bigger gap that allows you to build wealth. The next one is reducing bad debts and unnecessary insurance. If you have high cost debt, that's something that you need to get rid of as soon as possible, because that high interest that you're paying on a monthly basis is money that should be going towards your investments. And as long as you have high debt, you should probably not be buying new clothes or going to restaurants. The next very unfortunate thing is I see people putting so much money towards insurance products that they've been sold by someone that earned a great commission off these products, and not necessarily because it's in the person's best interest. I've even heard that some people have so much money going towards insurance products every month that they actually have no money left to put towards their investments. Of course, having insurance in place for certain risks is important, but don't fall for insurance products that are disguised as investment products, where they tell you that you can get your premiums back after a certain amount, and where they actually try to disguise it as a certain investment product where you will get money back from this. Have insurance products that cover a pure risk, like an income protection. It's time to do an audit and really understand the insurance products that you have, and also understand whether they're serving you or the person receiving a commission on them. Because if you've got unnecessary cash going towards insurance or going towards high debt, then this is something that you need to focus on to free up more cash flows to put towards investments. The next obvious thing to reduce is fees. There's a famous quote that says, "Where are the customers' yachts?" And this refers to the financial services and asset management industry, where there's so much money to be made by the people providing these products, but very little money to be made by the people investing in these products. So the people that own the yachts are the fund managers and not the clients. The hard truth is investment fees and the way that the wealth management industry is set up is actually draining your wealth or your money's potential earnings. And even if you think your fees are low because they're just 2%, that tiny percentage can reduce your total investment value by a massive amount over 40 years because of the opportunity cost of not reinvesting 2% every year. But here's the good news. This is within your control. You can choose not to pay those high fees on your investments. And you can do this by investing in low fee products where fees are lower than 0.5%. If you want to become more informed and understand how simple wealth building can actually be, definitely join my 90-minute free masterclass that's coming up soon. Follow the link in my description to sign up. One of the quickest ways to reduce your fees is by reducing your reliance on advisors. Many people don't realize that it's possible to make their own investments and that it's possible to cut out the advisor layer and associated layers of fees that comes with using an advisor. And this is a quick way to cut out unnecessary fees. Because if you cut out the middlemen, that allows you the freedom to choose investments that are right for you and not investments that suit someone else's commissions and bonuses and targets. Then you also don't have to wonder whether these investments are in your best interest or in their incentives' interest. Even though DIY investing is more than possible and it has become more and more popular over the years as more platforms are out there that enable this, it's still not the go-to option for a lot of people. But why? It's all about perception. Many people perceive advisors as having access to this insider knowledge, where as the public, you won't know the things they do because they drive these fancy cars and they have these suits and they have these airport lounges that the company gives you access to. The thing is, all of those things actually come with a cost. And if you think about it, you're paying for those things with your fees. And in reality, they don't have the secrets to becoming rich by investing. Let me tell you their secret to becoming rich. It's you. You are the reason that they're able to become rich because obviously they build their wealth on the fees that they charge you. But let's get it straight. It's not because they're evil. It's just how their business model works. They obviously need to make enough money in fees on the clients' portfolios that they manage in order to cover their reporting, admin, compliance, customer support, and they have offices that they need to run. I would know because my husband is actually an advisor and you would never say, but this means that I have a lot of insider information and I understand very well how the industry and how the fees and the business models work. But the thing is, you don't have to pay those fees. Another reason DIY investing is not the norm is because not enough people know and understand that it's within their reach. All the messaging and branding out there is filled with jargon on purpose. It's made to seem very complex with so many options that you don't know what to choose and words that you think you'll never understand. And that's all to keep you within a box so that you don't think it's possible to figure out or to do it yourself, so that you have to go to certain people and pay them to do it for you. But I can confidently say now that I've had hundreds of people go through my course that had no prior financial training, from teachers and artists to hairdressers, people that are from creative industries, all the way to people that have more finance-focused degrees that also didn't learn about investing. I've had a range of people with range of skills complete the course that were confidently able to open and manage their investment portfolios. So it is possible. Once you read through and understand some of the jargon, you won't be so overwhelmed. And the last factor, which is contrary to what most people think, is that doing less is more. As Morgan Housel says, building wealth is about getting average returns for an above average period of time. Instead of trying to outperform the market and to time the market to stock pick or to know which crypto to buy, it's much more about getting a plan together, investing consistently, and not trying to buy and sell at the right time. So yes, it's not day trading. A lot of people think when you become an investor, you need to constantly watch stocks and know when to buy and when not. It could really be as simple as buying 1 or 2 ETFs, the same thing every month. And all of that can be automated. So you're not timing, you're not picking, and you're not lending your ears to anyone promising a great deal or amazing returns. It's boring once you get used to the volatility, which takes some time, and it means not touching it when the market is down. Next week, I'm doing the last video in this 3-part series, and we're talking about the final part of financial freedom, which is what financial freedom actually looks like when you get it right. So make sure you subscribe so that you don't miss out, and also join my upcoming masterclass if you want to learn more. More info in the description. See you there.